Hello everyone, welcome to Tookitaki's webinar on AML CFT, our first one in a three-part series, Remodeling AML CFT program with new technology in COVID-19 and beyond. I am Abhishek, founder and CEO of Tookitaki, a global regtech company providing machine learning powered AML analytics to financial institutions. I will be the host of this webinar. Most of us has been locked in our homes for months now and have accepted and adapted to the new normal. Money launderers, on the other hand, exploited the COVID-19 situation and built a new world for themselves, specifically new schemes to move dirty money. Today, we will discuss the pandemic-led complications and emerging risks in AML CFT program and how new technologies like AI and machine learning can bring in clarity to many of these parts of AML picture. We would focus on two specific areas. Can this new set of tools respond to the new money laundering techniques? And number two, can these new tools automate a significant part of our daily business operation and bring efficiency? So let's find out from our speakers. Our first speaker today is Aaron Ray. He's a senior analyst with Celent for more than 12 years of experience. He speaks and publishes extensively on regulatory and technology trends in KYC and AML areas. He's experienced in developing technology and vendor selection strategy for financial institutions. Our next guest speaker is Mike Slover, who is a risk and control executive with more than 20 years of experience in compliance, risk management, and BSA areas. He has implemented successful compliance solutions in numerous global financial services like Goldman Sachs, Discover, American Express, and others. Currently, Mike is the owner principal of MCS Risk Advisory that helps clients address their compliance, audit, and regulatory challenges through advisory services. At this point, I'm going to turn it over to Aaron, who will get us started. But just to give you a preview, he will share with us the impact of COVID-19 on financial crime compliance and how modern technologies can be answered to both detection and investigation related challenges. He will also share some real life examples to strengthen his points. But before we start, I would like to mention that webinars and seminars are enhanced by participation. We would really encourage attendees and audiences to send us questions, which we would answer. Aaron, over to you.
Thank you, Abhishek. Hello, everyone. It's great to be talking to you today on this very interesting topic. At Celent, we have been researching and writing about AML technology since 2002. And in the last 3-4 years, we have been specifically looking at the next generation technologies such as artificial intelligence, machine learning, and their application in financial crime compliance operations. And over these years, 3-4 years, we have seen growing interest and increasing adoption of these new techniques in this industry. And we do expect that this COVID-19 pandemic will further accelerate their adoption. So obviously, COVID-19 has created an unprecedented situation in more ways than one. It started off as a health crisis. Then it severely impacted the economic health of the countries globally, and it also has major implications for financial crime and also implications for financial crime compliance operations at banks and other financial institutions. Some of the impacts of COVID-19 on compliance are new and novel, and then there are also other impacts and trends that have been happening for some time, but they are now being accelerated by this crisis. So, for example, we have seen growing digitalization in financial services, which has been underway for some time. And we have seen rapid increases in speed and also volumes of transactions driven by digitalization. And this includes cross-border transactions as well, which have now become much easier and much faster to execute. And COVID-19 is accelerating these trends. Because of the need for social distancing, we have seen people have drastically shifted their regular purchases and transactions to online and remote channels. And many who were previously reluctant or slow to use these digital channels, that they have now been forced to sort of use them due to COVID-19. Similarly, we have seen COVID's impact on sanction screening as well. Sanctions lists had been changing frequently prior to COVID, but now with COVID, we have seen that there has been significant disruption in supply chains, and governments have found that essential goods are in short supply and very hard to procure. So they have been forced to review sanctions lists and offer specific exemptions to certain entities, which means that financial institutions need to be even more diligent in their sanctions operations. And then on the other hand, we have also seen that digitalization also helps criminals because it gives them new tools and new avenues to operate, and they can now leverage new channels and new products. And COVID-19 is creating more opportunities for them. For example, now that physical gambling and casinos had to be closed, criminals are likely to move on to other areas such as cryptocurrencies and other segments, emerging segments. And then we have also seen that regulators and supervisory agencies have warned about the new risks of scams and frauds and money laundering involving critical items related to the pandemic, such as vaccines or test kits or other medical supplies. And they have warned that criminals can pretend to be dealers of these medical supplies and scam buyers into purchasing low quality goods or even non-existent goods, or criminals can pretend to be medical professionals demanding treatment related payments for someone's friend or relative, or they can create sort of charitable funds claiming to help those in need, but which may actually be sort of vessels for money laundering. Another area of new risk that's emerging is through governmental stimulus packages and bailout programs. And criminals can take that route, for example, submit fraudulent applications for economic relief programs. And we have seen in the news that someone claiming bailout money on behalf of businesses that had actually been closed many years ago. Then this crisis and these bailout programs also impact the valuation of companies and stock prices and commodities. And some companies have had to file for bankruptcies, while others get stock price boost due to governmental support. So insiders who have privileged information on upcoming action by governments or company boards, they can engage in insider trading or stock price manipulation and other nefarious activities. And we have seen even some questions have been raised recently about some senators' stock transactions recently. And the last point on this first slide is that the crisis has also disrupted normal operations at banks. Many banks' compliance divisions are not set up to support remote work at scale. Sometimes their staff may not even have personal laptops because they have to come to office and log on to the systems on a regular basis. Then there are other banks who may have offshored or outsourced their operations to other countries, and it could be that remote work facilities are not well supported in those countries. So if you move on to the next slide, please, we see that there are these new challenges created by COVID and also challenges that are intensified by it. But responding to these challenges are difficult because financial institutions we see are still working with old and legacy technology, which are primarily based on simple rules and are also based on known risk typologies of what has happened in the past. But this crisis has really created an unprecedented situation, and there is no known playbook here as to how patterns will evolve in such a highly fluid situation. So the existing systems cannot often detect unknown or rapidly evolving patterns emerging from a crisis like this. Also, the current systems that are in place, they have been at many banks highly customized over the years, and these customizations can be very difficult to change or upgrade. And it often takes significant projects involving a lot of resources and spanning over months to change them. So their speed and agility are very limited, especially when it comes to responding to a very sort of fast-moving event such as this one. And that is really driving the need for more dynamic and automated approach. And that is why we see growing role of advanced analytical tools such as AI and machine learning in this area. So on this slide, I have highlighted some of the challenges in each of the main compliance processes of how AI and ML techniques can help overcome them as well. But rather than going through every one of these in detail, I will quickly highlight a few and we can discuss others later if you're interested in specific items. So first, looking at KYC onboarding, here a key challenge has been risk assessment and risk coding, which traditionally has been highly subjective, where clients are grouped in broad buckets or matrices based on a few generic attributes. So this approach is very crude, and it is also very static because they are updated infrequently. For example, they would be updated once a year or 6 months for high-risk customers and more infrequently for others. And here we have seen application of AI techniques such as cluster analysis that allows much finer and more granular assessment of risk, where you can incorporate many more variables in risk assessment and then allow machines to find new segments and the boundaries of those segments. And in our research, we have spoken with banks. For example, there was a tier 1 Asian bank that said that their client segmentation previously was so broadly defined that 95% of their alerts were coming from just 5% of their client base. So they used cluster analysis to segment customers, and they found that they were able to reduce false positives by 40% in this exercise. And they also felt that this approach helped them improve their monitoring coverage as well. And more importantly, this approach can also make risk assessment more dynamic and more continuous, so that when there is a change or a customer engages in unusual transaction or there is a new screening hit on the customer, that their corresponding risk score may be automatically changed, and that in itself can trigger additional diligence on that customer. Then moving on to the detection phase, we have seen existing transaction monitoring systems also use very generic rules and scenarios and thresholds, and they use limited data types and attributes. And then these models would degrade over time invariably. So these models would need to be regularly tuned and optimized. And again, that can be a costly and lengthy process. But using AI and machine learning, one can analyze more volumes and different types of structured and unstructured data automatically. And they can incorporate more information, such as information from KYC profiles or behavioral information or network information and network risks, or say results from screening operations into doing transaction monitoring or due diligence and enhanced due diligence. And you can use these AI techniques to either sort of fine-tune the existing rules-based engines, or you can also come up with new rules and AI algorithms to detect previously unknown patterns. For example, you can use anomaly detection techniques to find outliers in customers' behavior and then flag them as potentially suspicious when needed. And the final phase is the case investigation, which is highly manual. And in our research, we have seen that compliance analysts typically spend 65 to 70% of their time on low-level knowledge tasks, such as collecting information from different systems, aggregating them, filing reports. And recently, there was a release from FinCEN that talked about the voluminous paperwork that's needed for SAR filings and the high cost of SAR filings. And a lot of it is actually operational stuff, doing manual and tedious work. And many of these activities can be automated using AI and robotic process automation techniques. For example, in case investigation, alerts can be scored using AI, and they can be ranked based on their risks and also likelihood of them being false positives. Then once you have prioritized those alerts, you can sort of the higher risk alerts you can send automatically into cases, and then the case can be populated, the case files can be populated with information that's automatically collected and aggregated. And you can send them to these higher risk alerts, you can send them to more senior analysts, while the lower risk alerts you can hibernate or send to more junior analysts for investigation. And in our research, we have come across a tier 1 global bank that said that they are automating parts of this investigation process using such automated search and querying tools. They are embedding geographical information on a visual map. They're also extracting information and insights from images or payment messages and documents through AI. And they said that they expect this can sort of reduce the case review time by more than 30%. And then there was another recent release and interpretive letter from the OCC in September 2019, where a bank proposed that certain structuring SARs can be actually auto-generated by machines by first automatically finding those structuring transactions and then generating narrative by software to file those SAR reports. So there can be many more applications. And if we move on to the next slide, please. Here Thank you. Here I have a very specific case arising from this COVID-19 situation, just to contextualize this discussion and talk about some of the applications in the context of COVID. And this example is based on specific comments and typologies that some of the regulators have mentioned in their recent guidance about COVID-related schemes. So here on the extreme left, you have the buyers of medical supplies, which could be hospitals, government agencies, and even individuals who may be looking to buy, for example, masks or other PPEs or ventilators. And they see a seller and place an order without doing all due diligence on the seller, because in this crisis, time is of essence and supplies are hard to find. So then they ask their bank to make payments to this seller. And in this case, the buyer's bank needs to be vigilant and make sure that such transactions are legitimate. So some of the things they need to check could be if it is a new beneficiary that their customer has not previously transacted with, or check the velocity of transactions between the two parties, because we have seen criminals often demand multiple payments in very short time. They need to check whether this transaction is of unusual value or the prices are unusual compared to how such items are normally priced. And in all these cases, you need AI and anomaly detection techniques to understand what is unusual price or what is how high velocity, and how do you quantify each of these to assess their risks. And then similarly, on the other end of this transaction, you have the seller, who may be a suspicious actor, and their bank also need to be diligent. For example, they need to check if this account was created during COVID-19, or if that was done through remote onboarding, in which case they need to be additionally diligent and ensure that all the documents and IDs are validated adequately to properly identify the account holder. Also, they need to perform the screening if that individual is on any watch list. And here they can use AI or natural language processing based techniques to improve screening efficiency and effectiveness. And they can potentially use additional fields to perform the screening checks beyond just name and jurisdiction and the other standard ones that they use. Or they can use advanced network analysis to find associated entities and networks that that person is connected to. Or they can also use AI-based adverse media analysis to find suspicious actions of this customer from the past or suspicious connections from the past. And then the seller bank can also look for suspicious transaction activities, such as if the account suddenly receives disproportionately high amount of money, or receives money that is out of sync with the stated purpose of the account at account opening, or if this business account is only receiving cash inflows, but there is no outflows or expenses going out. Again, understanding what is a disproportionately high amount or writing rules for all such possible scenarios using rules-based techniques can be extremely difficult. And this example I talked about is just one scenario, and there can be many more such scenarios and new typologies emerging from this crisis. And also we have to remember that both customer activity and criminal behavioral patterns will also evolve as we settle into sort of a new normal, whatever that new normal looks like. So it will be challenging to foresee and build rules for all such scenarios going forward, which is why we expect that advanced analytics and AI-based techniques will have an increasing role to play in combating financial crime in the coming months and coming years. With that, I will conclude my introductory remarks and turn it over to Abhishek and Mike for your thoughts, and look forward to discussing these in more detail in the following discussion.
Thank you, Aaron, for very well articulated points. It was very informational. I really liked your example where you spoke about the typology around the medical fraud that might happen. The cases that you pointed out around multiple transfers, disproportionate prices, are exactly areas where machine learning, like semi-supervised learning, can be really helpful, because you will not be able to build standard rules to detect those scenarios. And when you know and create clusters with defined behavior, you can easily detect behaviors which are not the normal ones, and hence detect those in a much more efficient and better way than you would have done using rules. That being said, I would love to move to our next speaker, Mike. Mike, as an industry practitioner, right, we would love to know from you how these sort of modern technologies like machine learning are critical to adapt to the new BAU processes and implement a more risk-based approach to AML CFT, which we believe is a more sustainable approach post-COVID situation. So over to you, Mike.
Thank you, Abhishek. Those were some really great insights from Aaron, and I appreciate the opportunity to discuss these timely topics with everyone today. These have certainly been challenging times, and it is clear from what we've seen now that banks will need to evolve. It will not only be about the tools, but about how people work with those that need to evolve. So I think it's important to understand how we got to where we are before we set a course for where we're going. And although risk-based decision-making has been around forever, it was really the COSO ERM framework that gave it traction with our regulators. And ironically, I was working with one of the principal authors at PwC at the time, and contributed on business continuity management of all things. But we soon saw risk management and risk-based approaches popping up after the COSO ERM release in things such as the EU's AML Third Directive and the US's FFIEC examination manual. Of course, this spawned a lot of debate in the industry and with our regulators about how qualitative or quantitative the risk assessments should be, and our risk-based decisions that flowed from them. But over time, we figured it out. And what was the result? Well, we were able to focus on those products, services, and customers that posed a higher risk to the financial system. And that allowed us to shift resources accordingly. It was not so much that we were doing less overall, it was really just that we were doing more in one area and maybe a bit less in another. For example, one of the largest banks in the US that I had done some consulting with made the risk-based decision that its entire credit card business was low risk, and therefore shifted a lot of other resources, that had been focused on that business to things such as their commercial lending business that posed a higher risk. In context, though, the entire of organization, that was an appropriate decision to make. Contrary, though, it would not be reasonable for a bank whose credit card business is a substantial part of the whole to make a similar decision. So risk assessments and decisions are not one size fits all. And if we can move to the next slide. Thank you. What risk assessments have really allowed us to do is think about, especially with the constant pressure to contain costs, is whether moving resources to low-cost locations or to a vendor would be within our risk tolerance. When I've gone through this in a pre-COVID world, my strategy to mitigate risk was always to spread across geographies in case of political instability, or if there was a pandemic outbreak like we saw with SARS and other things, it would be more unlikely to hit all locations at once. So maybe distributing to the Philippines, to India, to Poland, that spread it out adequately. This is obviously not the case any longer. That no longer holds true. So let's go to the next slide and we'll talk about some specific processes. Okay. So the governance and risk management processes on the left side are, of course, critical to an effective BSA AML program. However, if we need to pause the operation of these functions, it would not be an effort to, or I'm sorry, it would be a bit of an effort to catch up, but it wouldn't be overwhelming to the organization. In comparison, the factory type operations on the right side of the slide are driven by strict regulatory deadlines and are really part of other critical path processes such as credit decisioning. In almost all institutions, these processes are facilitated by rules-based engines. And these rules-based engines will keep running and generating alerts and alert backlogs when the large teams of people that normally handle them are not able to keep pace. Even a nominal reduction in human capacity can start to break the process. And I've experienced this firsthand during a bad seasonal flu outbreak. Resources can be shifted in the short run to avoid missing cutoffs for immediate processes, but as team capacity stays below normal levels, other deadlines will start coming due and we'll start missing more. So even if there is latitude from the regulators now, backlog could easily get to a point that will tax the organization and drain resources for a long time to come. So all of these processes have been put in place with oversight and subject to risk assessments. And how did it go wrong? Why do we make these bad decisions? Well, it really didn't go wrong. We didn't make bad decisions. We made the right decisions at the time, but times are changing. Banks have been quite smart about directing resources to higher risk areas. They've leveraged tools such as RPA and use those tools to speed up processes. As AIs become more widespread in the banking industry, many AML teams looked at how to leverage it to make better decisions. One of the uses that I implemented was the use of AI to build links and develop these internal networks to identify amongst our customers to identify trade-based money laundering. That really helped us see things that we wouldn't be able to see just with our human eyes. This has really been a terrible event by any measure, right? But banks should look to glean lessons from the experience and not just sit back and operate the way that we've operated in the past. I believe that every bank should further the risk-based journey, and it really is a journey that we're on, and look to reduce reliance on large teams of people for their AML operations through the use of automation. In addition to the obvious functions such as KYC, transaction monitoring, sanctions, and so on, other functions such as model tuning can be done much more effectively through machine learning than a human-driven process. My model management team leader told me one time that an aggressive plan would have us tune all of our transaction monitoring rules in 4 years, and that's an aggressive plan. Through machine learning, a vendor is able to do this with documentation on a continual basis. So the efficiencies are clearly out there. A difficult question that always comes up is whether the regulators and auditors will be accepting of the shift. In my experience, engaging with examiners and auditors at the right time is crucial. Too soon, and the idea may be too conceptual for them to buy into. Not soon enough, and they may feel shut out of the process, and it'll be difficult to get them on board. Every organization is different though, and one team of examiners may operate differently from another team from the same agency. So while there's no uniform optimal time, it certainly helps to have a proof of concept so actual results can be reviewed against legacy process through their risk lens. Right? So I think we can get there. I think there's processes to improve, and I think this is the right time to do it. So with that, I'll turn it back to Abhishek.
Thank you, Mike, for the interesting session and the insights on evolution of risk-based approach. That was pretty insightful. What is more interesting is that we are also seeing connection link in COVID crisis and also adoption of technologies in this approach as well. So as we move on to a panel discussion, I would love to take your views on the recent data that we figured out about changing customer behavior. And is this behavior actually sustainable post-COVID era or not? So we would love to talk about few changes, tools that will cater to the new post-COVID era, and is that behavior sustainable going forward? So during this panel session, we would be launching polls to engage with our audience. We would love to see and get their views. So I would request the audience to watch on your screens and would love to see your participation. So starting the panel discussion, I would have the first question to Mike as a practitioner across multiple financial institutions, Goldman Sachs, American Express. I would love to know from you, right, in your view, which one of the use cases or which of those use cases you see getting a lot of traction in the AML CFT space, specifically in the adoption of AI AML technologies. I would love to hear your views, Mike, and then I'll hand it over to Arvind as well. Over to you, Mike.
Great. Thanks, Abhishek. Well, I think there's really two types of processes that are good candidates. Yeah, and I'll speak generally about the types of processes, and then we can dive in, and I'm sure Aaron has some examples too. But the first ones are the ones that produce high output, like sanctions, PEPs, transaction monitoring alerts. AI, and more specifically machine learning, can really help cut through the noise and focus in on the ones that matter. And I think Aaron gave some examples, and we've done some of this as well, where previously investigative teams have manually scanned through alerts and segmented them and sent them to specific investigators or to teams based on whether they're high or low risk, using obviously their more experienced investigators for the more complex cases. Or maybe an investigator is really sharp at trade-based finance, money laundering, and so you send the cases to that person or that team. What we've started to see, as Aaron pointed out, is that that's really a great use of AI, and taking it to the next level. What can we do for post-processing to even get it further? To make automated decisions or suggestions. The second type of situation, software's cases where the rules-based engines can't find anything effectively. And that's probably a bad way of casting them in that light. But I'm talking here about again, trade-based, money laundering, really tough to find using basic rules. Human trafficking is another example of that, where general legacy rules, they're not very useful, but employing the AI and machine learning, I think that's really going to cut through and be able to see things that we're not able to see with the human eye or simple rules.
And if I may just quickly add a couple of points and maybe largely reinforce Mike's points, but from a different perspective and lens. So if you could look at more the short-term and immediate impact, and more, and then on the medium-term and longer-term use cases. So in the short term, as Mike said, that there will be backlog of cases because banks are staff constrained, and so the main focus would be on improving investigation efficiency, because as Mike mentioned, there would be backlog of cases. So any and all tools that can improve investigation efficiency would be welcome. One could be using AI to triage alerts or enrich alerts, and then you could do AI-driven alert coding and prioritization, which would further improve efficiency. And actually, we have spoken with banks, including a large regional bank, that said that they worked on coding and prioritizing alerts, and in their experience that revealed that over 40% of their alerts could be sort of closed with minimal supervision. So there's a lot of room for efficiency improvements through these technologies in the shorter term. And then when you take a more medium and longer term view, I think risk segmentation and continuous risk monitoring using AI and machine learning based on some of the earlier use cases that I talked about would be an important step, because a lot of the reasons for false positives lie in sort of getting a good 360-degree view of customer and getting a good picture of the customer's risk. So if you can use AI-based clustering and other techniques to improve the risk assessment, that itself could be sort of a big boost to both the efficiency levels downstream, but also the effectiveness and coverage of your AML programs.
Got it. Thanks, Mike and Aaron, for your views. It's quite insightful that we are seeing that in this in this situation, right? Banks are focusing on bringing in efficiency, specifically in their alert triaging and prioritization process. And as you said, right, techniques to actually enable that is one of the key areas of focus. My next question is essentially an extension of this. We did some survey across multiple banks before this webinar, and in general, what we saw was that what we are seeing is cash withdrawal has increased more than 50% of the sample of banks that we kind of interviewed. And what we are seeing is few of the banks are also waiving off ATM fees for consumer for easy access. But the banks are also worried that when the situation stabilizes, customer will start returning their cash to their accounts, and hence this will have an impact on their alerts volume and false positives, right? So would love to know your views, Mike and Aaron, that these sort of changing behavior that is happening, both pre-COVID, post-COVID, right? Do you think that the financial institutions are prepared to handle these sort of changes, specifically in their AML rule-based systems that they currently have?
Yeah, I'll start, and then Aaron can jump in. Well, this is certainly going to be a struggle for banks using their traditional rules. Typically, these rules include velocity components and other factors that are impacted by the customer's previous behavior. So when you're starting to see a change in behavior, whether it be cash in and cash out, moving quickly, obviously you're going to trigger some of those velocity elements, depending on where the limits are set. So if you cross those limit thresholds, but regardless, you're going to see banks having more alerts as a result of this. So I think they're really going to need to explore opportunities to do some post-processing on these alerts, to look for ways to implement false positive reduction logic, and so hopefully that'll be a way that banks can get maybe dip a toe in the water, or maybe go up to their waist if they haven't already, with some additional what I would call AI, or at least RPA.
Got it.
If I may quickly add a couple of points to that. So I think the need of the hour is nimbleness and agility to respond to these changes, because as I mentioned, customer behavior is changing. So if there's unusual with respect to how the customer was behaving previously, that of itself now may not be suspicious, because customers are forced to change their behavior. And similarly, criminal behavior is also changing. So you need to be nimble and agile to respond to these changes and update your models quickly. But going back to Mike's comment on the banks taking 4 years to sort of fine tune and optimize their models, that 4 years, you cannot afford to spend 4 years doing that. And that's so keeping up to date or sort of continuously tuning your existing rules-based systems can benefit greatly from using AI and machine learning techniques. And then you also need to come up with new scenarios and typologies that are emerging, which your rules-based systems cannot find at all. So there also you will need AI and machine learning techniques to be able to sort of catch them. And then obviously, regardless, you will end up with a lot of false positives. So anything that can make alert investigation more efficient should be welcome.
These are great points, Aaron, and I think that can segue to one of the questions that I always wanted to ask is, we are talking about multiple things, right? We're talking about, techniques which kind of enable us to be more effective in adopting our sort of AI tools into this sort of to this AML journey. We're talking about, certain regulatory changes. We're talking about process changes, which Mike talked about. Aaron, would love to get your views that if you have to summarize as a industry analyst talking to so many banks, right, and helping them doing vendor and technology strategy decisions, if you have to summarize 3-4 points on how do you think financial institutions can accelerate their journey of adopting AI, what would be those points? Would love to hear a brief from you.
Yep, if I have a slide to discuss some of those points, if you could, thank you. And we have been researching on this specific topic of AI adoption in AML since 2016. And when we started this research, at that point, to many banks, it sounded like sci-fi movies, even though some very large global banks were quite early adopters of these solutions, but many were still sort of taking a lot of wait and watch approach at that time. But in the last 12 to 18 months, we have seen a dramatic shift in attitude and interest, and also in terms of adoption. So not only there have been a lot of pilots and proofs of concepts done in this period, but we have, in the last 12 to 18 months, we have also seen that many banks sort of started to take some of those POCs and pilots into production, and their live adoption is well underway in the industry, I would say. And it's also interesting to see that it's no longer just a play for the very large global bank of the HSBCs of the world. What we see is many regional banks and top national banks are also quite active and interested in exploring and adopting these technologies. And we do expect that this crisis will change many minds who are still reluctant or who had been reluctant prior to COVID about using these solutions, because the benefits can be so much. And another change in attitude, so to speak, we have seen is from regulators. We all have seen the 2018 December paper from a group of authorities, supervisor in the US, who have sort of actively encouraged banks to explore innovative technologies using AI, including AI and machine learning in financial crime compliance operations, and many in the industry think that to be sort of a game changer. Admitted that as Mike said, there are differences between such top-level endorsements or encouragements versus the ground-level reality of how auditors and examiners sort of do their work. But still, if you consider the history of AML operations, such encouragements, I would say, are quite significant and can be sort of influential. And also, you may have seen the recent publication from FATF, whereby they also encouraged use of technology, and they have also encouraged use of fintech and regtech and subtech, which is supervisory technology, to the fullest extent possible, in their words. So they are not only just encouraging the new technology, but also encouraging banks to work with new partners. And the good thing is that in this last 3-4 years, we have seen that many off-the-shelf solutions emerging for many of these different use cases that we spoke about, and there are others as well. So banks don't need to sort of reinvent the wheel and invest heavily in in-house development for building such use cases, because in-house development can be costly and risky and lengthy. And many banks, frankly, don't have the AI and machine learning experts to invest in them. And even those that they have, they would be rather putting them to front office revenue generating activities. So adopting the off-the-shelf solutions can be sort of a faster route to getting the real benefits and ROI. And also what we have seen is there is no need to rip and replace existing systems, because some of these systems are heavily entrenched in the banks, and they are there for a reason. They are liked by regulators. They do their job. So they have their role in FCC operations, but AI and machine learning solutions can be sort of adopted on top of around the existing processes. So we have seen several strategies. So it could be take the alerts from rules-based systems and then apply AI for alert triaging or alert scoring and prioritization, or do an AI-based risk segmentation and then feed the results to your existing transaction monitoring systems, or do a machine learning based detection engine, but use it as a parallel sort of a champion challenger to your existing solution transaction monitoring system, and then compare the results. So there are many strategies that exist that don't need you to rip and replace and can sort of incrementally adopt these technologies in a less risky and less cost-effective way. And we have seen, as I mentioned, from the several use cases and benefits, that they can bring in significant efficiency improvements, and also they can improve the effectiveness by sort of capturing or detecting false negatives that banks were previously missing out on. So I think there is a lot of benefit that they can give, and I do expect that this crisis to sort of accelerate their adoption in the next months and years.
Thank you, Aaron. And Mike, do you have any thoughts before we move on to the questions that we are getting from the audience?
I would just I agree completely with what Aaron was saying on that topic. I think it's a a really ripe time to to be moving forward with this. We will need to engage very closely with with your regulators as we're doing this, but I think not by if we're not ripping and replacing, implement entire new systems, it's more augmenting the capabilities than introducing something new. I think that's really a powerful message to the to the regulators and auditors, which will keep them on side rather than put them in a defensive mode.
Got it. Thanks, Aaron and Mike, for the views. I really like how we were able to sum it up into 3 buckets, right? One was no rip and replace. It's much easier to complement your existing solutions so that we can see ROI quickly. Number 2, which is off-the-shelf product which can be quickly productionized, is the need of the hour. This kind of fast tracks the discussion around build versus buy, and then banks can make a decision to use those off-the-shelf products which are currently existing. And number 3, right, which we talked about, focus on efficiency across your AML process, be it sanctions, monitoring, so that it can help in this sort of a post-COVID recovery stage as well. So I think our audience have some takeaways and can use those in their upcoming daily processes as well. So we have number of questions, and thank you audience for sending those in. Probably we can take 2 questions at this point of time. One of the question I see, I think for Mike is and as an industry practitioner, I think he will be the best person to answer. One of the questions that are coming up, right, in this sort of the COVID situation, a lot of the financial institutions have started to work remotely, and we have seen that the volume of alerts have also gone up. How do you think that using machine learning and analytics in the alert triaging process, which can technically kind of bucket these alerts into least suspicious segments, the current in the current BAU processes, do you think that we can bring in hibernation model to really bring in the efficiency that we are looking for? Mike, any thoughts on?
Yeah, sure. I'd be happy to share some thoughts on that. But just as a as a quick aside, one of the questions that I've been asked a lot recently outside of this forum about working remote and having investigative teams not in their typical environment is about monitoring the activity of the investigators. Outside of the sterile rooms that we normally have our investigative teams in, so more surveillance of our of our investigators, which I thought is an interesting query that came up out of this COVID-19 situation. But with the alert hibernation, it's certainly a really powerful tool in our kit, as long as we deploy it correctly. Standard practices for hibernation include where the potential suspicious activity does not, maybe score adversely enough for the alert to flow into a case queue. But may reach that level in the future as additional activity compounds on it. So it's a really really powerful tool to kind of park it, somewhere, not forget about it, not to ignore it, but to keep it, keep it warm, as it were. I don't really expect that to change. I think that will continue as it has. There may be that opportunity, though, for banks to use AI and machine learning technologies, as we were talking about before, to really kind of dive into these alerts, post processing. I like to call it post processing, because we're not changing that up front. We're not ripping and replacing that existing rule set. We're just operating on it after these alerts are generated and applying the machine learning, to really, kind of get, sort through that data and look for things that we're not able to see with the human eye, and then to place it in, these queues for future activity to add to it, or to nominate for closure. And what I mean by nominate for closure is they're not going, the AI machine learning is not going to automatically close alerts for us. We don't want that. All right. What we want it to do is to say, hey, here's a bucket of alerts that you may, that we don't see, we meaning the machine, we don't see as, as probable, right? So maybe, it would be, sent to another queue or a different queue for that type of investigation.
Yeah. And I'll just add that we have been seeing that just prior to COVID, in the last 12, 18 months, we have seen that alert hibernation model has been sort of becoming more and more popular. And the reason is not only that we know that a huge share of false positive, of 90% or even higher, but also obvious false positives. So I spoke with the bank, and they said that they did some AI-based analysis and alert ranking, and they think 40% of them are obvious false positives that can be closed with minimal supervision. Yeah, we have to be sort of careful about terminology, and I agree with Mike. No one is talking about auto closing, but many can be sort of quickly closed through minimal supervision, for example, by junior analysts. And machines, as Mike mentioned, they can also generate the reasons of why they think that some alerts are of low risk. And then you can have an analyst see the reason, and if when needed, they can overrule that reasoning. But you can sort of greatly help the job of the analysts and during that post-processing period, which Mike mentioned, to sort of significantly improve the efficiency of the process, rather than having senior staff going through very mundane alerts. Even if it takes very small time for them, it's still a drag on productivity.
Got it. And Aaron, I think there's another question which I would like to pick up here. Is the question that I'm getting here says that what are the key aspects financial institutions should consider to select an AI-powered software vendor in monitoring and screening? You being a practitioner and helping banks do that sort of a vendor selection strategy, would love to hear your thoughts.
There are a few points. So first, obviously, would be performance. You need to demonstrate the solution works and works in the context of financial crime. So AI is a generic technology, but applications can be several, and each domain will have their specific requirements and needs. You need to train the models for that specific environment and that domain. So first of all, you need to have demonstrated that that vendor has a solution that works and gives you the results and gives you the ROI. So proven results, whether it's working with other financial institutions, that should be of great help. And if that a vendor has established working for another financial institution and given them ROIs and efficiency improvement, that should be a strong indicator of their performance. And in this context, I should mention, spoke with another bank recently, and it was actually mildly surprising for me that they mentioned that they saw that there was another bank, peer bank, that has applied many of these advanced technologies. So they wanted to understand, and they contacted that bank's, the other bank's compliance professionals, and it turned out that both had a very fruitful conversation, and this bank learned quite a lot from the other bank. So it seems like banks are not just competitors, but in this area, they are perfectly willing to collaborate. So you can sort of talk to your peers and get insights on how to adopt these solutions, including vendor recommendations and what the experience has been for working with vendors. And also, if a vendor has done some work for a financial institution, that may itself work sort of a passport, because now it would likely be that they have also talked to the regulator while working for that vendor, and the regulator is familiar or understands the solution. So it can be a passport to sort of getting to work with a vendor who has such demonstrated work. And also, it's not just demonstrated work in terms of proofs of concept or pilots, because it's one thing to do a pilot based on 3 months historical data, but also whether they have operationalized and industrialized at the scale and at the level of regulated entities in financial services. That's also important. Another thing that we see is, and we see it in software across several domains, but it's also important in AML compliance, is that the software has to be consumable and easily adaptable and changeable, mostly by business users as much as possible, because banks are looking to move away from long technology projects for regular change, because that's costly and risky. So if the solution is amenable to quick changes and quick, easy use by business users, that's another positive for such solution. And I think the last point that I would mention is around explainability and transparency of AI models. We all know that AI models can have perception challenges in terms of their power of explaining. So how a vendor is helping explain their models, how they're helping document the results, validate the results, and explain them to regulators and auditors, and also reproduce the results there, that would also be important, I think.
Got it, Aaron. I think these are very good points. And that being said, I would like to close this session today. Thank you so much, Aaron and Mike, for the session. This was really helpful. And on behalf of Tookitaki, I would really thank the audience for your participation today. We would look forward to welcoming you all in our second webinar, which is Crossing the AI Chasm. This will be held on June 23rd at 11 a.m. EST. What we would do is that, there were a lot of learnings in this session, starting from Mike, Aaron. What we would do is we would create a small sort of a token of the learnings and send it out to all of our audience and panelists. Please keep a watch out on our emails. So we conclude the webinar here. Thank you, speakers and audience. Goodbye and have a great day. Thank you.
Thank you. Take care and stay safe.